Hey, you want to learn what a cap rate or capitalization rate is and how to calculate it and what it means if you have a low cap rate between a higher cap rate? And in this video, in a second here, I'm going to go on my screen to show you detail what it is and how to calculate it and between the numbers of higher or lower. All right, in a second here. Boom. All right, I'm here now on my screen in my Google Docs document here about cap rate. And we're going to talk about cap rate for a little bit here. First, before I talk through how to calculate cap rate, let's first know what cap rate actually is. So, the capitalization rate is calculated by dividing a property's net operating income by the current market value. The ratio expressed as a percentage is an estimation of an investor's potential return on a real estate investment. So basically what that means is, so you have the market value of the property. So it could be 200,000, 500, 800, 300, whatever the market price is. The market value price, not price, to the closing costs, and that could add up the closed costs. So you have that number, whatever the value you searched on the property, and then you figure out the net operating income or NOI. And so I'm not going to explain what the NOI is. Maybe later in another video you could search on the internet what the NOI is on a property and what it is exactly. Okay, step one, you calculate the NOI. Basically, figure out the income. So you figure out the NOI is. So for this example, let's say your NOI is $1,000. So $1,000. So let's one more zero. So it's $1,000, and then step two, you calculate the cap rate. Okay, so basically what you do, you bring out the $1,000 and you divide that by, let's say $200,000 is the market value of the property I want to invest in. So I bring up my calculator. So I go $200,000 divided by $1,000. Okay, it should be 2%. So I did it wrong because you're supposed to divide it by the NOI first and then the market value. So divided by $200,000. Yeah, it's 5%. So it's 5%. Oh, I didn't even show it on the screen. Forget that. Yeah, see, it's 5%. Don't worry about these like decimals. So 0, 0, 0. So you just bring out the decimal twice or 3 times. So this kind of like goes 1, 2, 3. So it's 5%. Basically, it's 5% on the cap rate. So basically, I'm going to say 5%. And you want your cap rate. You don't want cap rate anything less than 5%. That means it's, in my own opinion, I think it's a bad investment. If it's like very low, then 4, 3, 2, 1%, it's not good. And this calculates on your return on capitalizing the value of the property. So this doesn't mean like you need to put 5% down. That's not what it means. So 5% is the percent of the return you're potentially going to earn end of the year. Okay? And so cash on cash return is much different than the cap rate. I might do that in another video and what the difference are. So cap rate and cash on cash return is much different, if I explain it more. So cap rate is the return of the market value purchased it at $200,000. That money that you gained could grow, type of thing. So thing is the goal here is to get a return of your investment. So for example, for you guys to understand, so lower the percentage. So if you have a 5%, it's a lower risk. You don't need a lot of money, or you don't need a lot of money to get into that property. But if it's like a 8%, like it was at 8.3%, but 8% or above that, whatever, 8, 9, 12% is a higher risk and a greater return. That's what it is. But it's a higher risk, and you probably need to put like a lot of more money in the property. So, assuming you're putting like 20 to 25% down, right? And it's not a good idea. I'm advising it's not a good idea to put all in cash. And some people out there are going to say it's a good idea to put all your money in cash for $500,000. Like if you do have $500,000, it's not a good idea to do that. Well, as I say is if you speculate, meaning I don't know how much it is. I think it's like 25. Let me kind of do the math. I think it's, if you put 25, I think, I'm not too sure on that. Yeah, I'm not too sure on the math here. So if you have $500,000, you don't want to put your money in one basket on one property. So if you put $25,000, I'm trying to do the math here. Okay, so maybe it's like 50,000. If you do 50,000, so $50,000 times 5 properties. Okay, so let's say we do 50,000. I think that's like 10, right? Yeah. Okay. Okay, it's 10. So let's say you have $500,000 and you do invest $50,000 down on each property. 10 properties, right? 10 properties. And that's a great strategy, okay? And you would probably double your money time. So you probably would earn $1 million and more in return. So, and not all these properties are, a lot of these properties, I think it might be like anywhere like 150 or 200,000, around that range if you're putting 20% down. But anyways, in this realm speaking, like when I was talking, people might say put it all in cash. Reason why people say put your money all in cash on a property is you're not, the money, the property itself is all paid for. You don't have to, the house is all paid for. You don't have to pay any, you don't owe any mortgage payments or any payments that is still owed on the property. Your mortgage balance is zero because you paid $300,000 in the extra and closing costs if you're doing that. A lot of times buyer negotiates for the seller to pay for the closing costs. But for other things, so in here, I think, so basically in here, the training, like step 1, you calculate the NOI, right? So that's adding all the stuff, so all the expenses. So you add all the expenses and subtract the rent. And then that's your monthly NOI. And then times by 12, that's your yearly or annually NOI. And in this case, it's $17,820. And this is all gross. It's not all tax at all. It's all gross right now. And then basically you kind of do this. This is another example. You kind of like for $300,000, 8%. And so, for example, let me kind of like find a property to make it easier. If I go to, let me go on redfin.com when I'm actually doing it. So if you go to, let me close this out. So go Redfin, and then let me look for houses in, I
I specifically don't want to look for houses. I want to look at apartments. That's kind of like my thing. I want to look at, where I live. I live in Seattle. So in Seattle, there's over like 400,000 people, and there's a lot of apartments downtown. So, and then what you would do, like, I really love Redfin. Redfin is probably my favorite brokerage website to look at properties, whatever. And then I would go condo. If you're just browsing and to do this, practice on this mathematical procedure, and then whatever you're looking for. So I'm just going to go on that, and then let's say for the sales price, wait, no, it's for sale, so I don't want maximum. Let's go anything to $500,000, and then all filters. So basically what you could do is, so max, I want the max like anything 1,000, yeah, nothing more than that. And then 1-car garage, and you guys could like change all this stuff, like price per square foot. You could have this like $150, or there's not really a lot of property, so I'm gonna put that no mats. Square feet like 750. Now that's good. All right. And then when you're looking at, because a lot of these are like 1 bed, 1 bath, and a lot of 1 bed, 1 baths are relatively cheap. Okay, when you go on the site, basically you're just looking at the prices in the pictures. That's what you want to do. So let's look at okay, let's look at this one. It's selling for, okay, it's 2 beds and 1 bath. Let me look at this. So you just kind of like look at these photos, whatever. Has a pool, and make sure you have like a goal. What exactly you're looking for, Do you want it to have a community, or you want it to have or anything of those additional things? Do you want it to have a pool? And a lot of pools sell. So if it has a pool, it's a bonus. So if you could do the math. So basically Redfin does this whole monthly thing. So if you put like 20% down, it tells you how much that is, exactly how much 20% is. If you put 100%, it's that. And then if you put like 50%, and then it tells you like, well, let me go 20%. And 20%, you don't want to go above 30%. 20% is a good spot to start. So that's only $85,800 for a $430,000 property. So, the lenders are going to be way different on the interest rates. So, so you would be paying around $2,033. Let's say I got a 5%. Okay. And for interest rates, say for interest rates, you don't really want a high interest rate like 8%, because you first need to prove yourself first. And then a lot of lenders, if you're like a good borrower borrowing, this much money to buy this property, they would allow you to get a low percent. So, and then property taxes, 313. HOAs, oh, this one has an HOA, 545. And then $79 on insurance. These numbers could change. So homeowners insurance could be $80 on whatever you're browsing on, whatever insurance company you choose with. HOA dues, sometimes that changes, sometimes it doesn't, depending how long you keep the property. This always changes. Property taxes always changes. And then this, every year this goes down. It's called a loan pay down. That's a benefit and advantages in real estate. So similar, what you would do is you kind of go on the calculator, and then so you go like 2030. So let me just use the number they gave me, 2009,771, and then you need to add in here, because it's only really a scientific guesstimate. You don't really know what it's going to be, so all it gives you is the property taxes, principal and interest, HOA dues, and homeowners insurance. The rest you need is the utilities, utilities and the maintenance and property management. So let's just assume water is like $80. Let's just say that, and then electricity is $100. And then maintenance, let's just keep it safe for another $100. And then property management, let's say they keep like 8% or something like that. And then let's say it's like 150 or so. And then let's see. And then knowing your market, because this area, I know it's nice and all. So, and you guys could also do this too. So you could open Zillow, okay? Because Zillow is really good on this one thing that Redfin doesn't have. So it's a lot of these ads. So what you would do, and I like doing this when I do this. So when I want to get this math, so you want to like paste the. If you actually know the property is, you could do it on your own. But because I'm not there right now, let me actually, because Zillow gives you how much this rents. So let's see. If you know the area very good, so this place is last rented from Rudimer Property Management Company for $2,000 a month. Let's say for example, I rent this for $2,000 a month. So you go. So my expenses is going to be $3,401. All right. But you really want your rent to be more than the mortgage. This is the thing. You really want it more than the mortgage. And then knowing the area, and it says here you could. Oh wait, did it set it? Yeah, around like 2,732. That's like the rent estimate. Okay? That's the estimate. So okay, 3,401. Let's go like, maybe I could probably, knowing my property management company, I could rent it for that much minus. Yeah, see? For this property alone, I already know this is a bad investment already. Because there's these what do you call them? There are these investment calculators, so you don't really have to do the math on your own anymore. And I don't know if I can link not my own, but like the one I use. It makes the math so easier nowadays to get a price and then see like how much you're putting down and put the expenses. So yeah, that's probably a bad one. And yeah, so basically you kind of like go through, and then let me look at this one right here. So it's 2 beds and 1 bath. And yeah, you don't want anything that's going to be to lose your money out on a property, okay? So basically you're probably going to pay, you need to put like $94,000 down. All right, that's a must. And then that's 20%. And then you're paying like maybe $3,074, And I think this place could, because the average rent here in Washington is $2,500. In Seattle, $2,500. I know. 'Cause that's the reason why people say put all your money in the cash in the property. Because the thing is, you're spending, like, if you put how much is this? $470,000. If you do that, basically, you're making more money if you put the money all in the house. So you're really only paying this much, $846. You don't owe any money anymore. You still have to pay HOA dues, homeowners insurance, property taxes, and all that. $846. Let's say that. So let's say you rent it for $2,000, and then minus, I don't remember, like 846. So you would keep that every month, and then times by 12. For a loan, that's how much you would make per year on this property. That's the reason why people say put your money all in cash, but I prefer to put like small down payments on a house, apartment.
Well, unfortunately, this is going to be the end of the video. If you learn anything in this video about cap rates, how to calculate them, or you actually learned something new today in real estate, leave a like on this video and follow me. And I will see you in the next one for different real estate advice.